Thanks, everyone. We're excited to be here with you today. My name's Matt Becker. I'm a director in BDO's nonprofit practice. I've been serving the nonprofit industry for over 15 years. And we're really happy to share some of this information with you during these challenging times. And really discussing a lot of these events with some of our clients, it really highlights for us why nonprofit organizations and the work you do and your missions are more important than ever. We titled this breakout session the now normal rather than the new normal, because in a very short period of time, our lives have been disrupted, and the now normal, whether on a legislative basis or financial basis, keeps evolving by the day. Like many of us and the service providers here to the industry, our goal really is to share a lot of the information that we're presented with and help understand it and then redisseminate it, because it's important that we do get through this together. With that said, I'm really thrilled to be joined by my colleague, Natalie Enclade, who's the director of our Community and Organizational Resilience Advisory Services, who's going to walk you through some of the critical insights from a legislative basis.
Good afternoon. Can y'all hear me?
Yep.
Okay, perfect. Been having challenges with the mute button all day. So I am glad to be here with you guys today. I'm going to go over the CARES Act specifically as it relates to the SBA loans, and then talk a little bit about some FEMA grants, and just different ways you can tap into money issues for your nonprofit. A little background about me: I spent 10 years with the Homeland Security Inspector General overseeing FEMA programs and FEMA grants. Then I spent some time with the Senate Homeland Security Governmental Affairs Committee creating these different grants and different types of legislation similar to the CARES Act. And then just joined BDO from FEMA. So I'm a disaster all the time in every sense of the word, as you will probably get a sense of right now. I can't get off the mute button. So we'll start with some of the disaster loan programs. These programs were rolled out really, really quickly, and a lot of these regulations were not implemented. And just last night, SBA and Treasury released clarifying language to the interim rule that they released the week before. So full disclosure, I have not had a chance to completely dig into the weeds on that one. So we're going to go over it. If you guys have any questions, I'm happy to get back to you on those. There's been a ton of confusion about these, and hopefully we can clear up some of the questions and inaccuracies of these programs. The overall goal of the CARES Act was to assist businesses and nonprofits facing financial strain as a result of COVID-19. Organizations are eligible to receive an economic injury disaster loan and a couple other various loans under other programs if the basis of loans are different. There are two small business disaster loan programs: the Paycheck Protection Program. You can probably hear this one as PPP or Tri-P. Then also the EIDL. That program. So everybody's in love with the Paycheck Protection Program because there is a forgivable loan offset in this program. So this program can be used for payroll cost, employee compensation. This excludes compensation in excess of $100,000 on an annual basis, continuation of healthcare benefits, interest payments and mortgages, rent for lease, utilities, and interest on any debt. And so payments on mortgages, lease, utilities, and interest on debt, this is all incurred. You had to be in operation before February 15th. So that's an important thing to note. You can't have started on February 16th and expect to get the forgivable aspect of this loan. So to qualify for this loan, it's limited to 501c3 organizations, 501c19 veteran organizations, and tribal business concerns. Oh, yeah. Is that Adam? Was that? somebody talking?
Just keep going. I guess somebody must have been off
Okay.
mute.
Yeah, I wouldn't talk over you, Natalie. Don't worry.
Okay. Was that you?
No. Want to hear what you have to say.
Okay. Well, so this is something, so the clarifying language from last night actually expanded this. So everybody, you've probably heard that it was 500 employees, and that was pretty much the standard. It couldn't be more than 500 employees. So Treasury last night put out clarifying language on this, and I'm going to pull it up and read it. Okay. So it's saying if you're a small business concern, you can be eligible borrower even if you have more than 500 employees, as long as you satisfy existing statutory and regulatory definition of a small business concern under Section 3 of the Small Business Act. So what does that mean? There's a test on the SBA's website where you can check on industry size standards. So the business, if it meets the SBI size alternative size standard as of March 27th of 2020, your net worth of the business is, when I say businesses, also applies to, it could also be your organization. Maximum tangible net worth of the organization is not more than $15 million. And the average net income after taxes, well, okay, that doesn't apply, is 2 full fiscal years before the date of the application is not more than $5 million. In addition to this, a business is eligible for this loan of 500 or fewer employees if the principal place is in the United States or the business meets the employee base size standards for the industry in which it operates. So 501c3s are eligible for this loan. Okay, so that is a prime example of how this loan keeps evolving. A lot of these programs out of the CARES Act did not exist. There was no framework. Treasury and SBA did not anticipate that these programs would come to them so quickly. They had 15 days to develop these programs. Treasury had 30 days to develop a few other programs. So they rolled them out pretty quickly to get the money in the hands of the organizations that needed it. So they're going to keep refining them because a lot of things were done quickly. So they have rules and regulations out there on how to calculate the maximum amount you can borrow. So you need to develop your payroll costs from the last 12 months for employees whose residence is in the United States. And you need to subtract any compensation paid to an employee in excess of an annual salary of $100,000. So this is also a point of confusion. So if you have an employee making $120,000, that's not to say that you have to exclude that employee from your application. You just have to exclude the $20,000 of their compensation from the application. So you take your entire payroll for that time period and then divide it by 12. And then you multiply the average monthly payroll cost by 2.5, and then that is your that is the amount of the loan that you can receive.
And Natalie, just to quickly jump in there, in a lot of our conversations with your clients, depending on who your payroll provider is, like an ADP, they can do this for you. So we're recommending that our clients reach out to your payroll providers to help with these calculations.
Excellent idea.
Yeah.
Yeah. Okay. So the loan application is available on Treasury's website. Part of the clarifying language last night that came out is contradictory to a lot of the guidance that was given out the first week of passage of CARES that was saying go to your lender. So part of the PPP that is unique is that these loans are filtered through financial institutions, whereas other SBA loans come from SBA. So a lot of the guidance was to get guidance from your financial institution. So the clarifying language that came out from Treasury last night was that is not the case. The financial institutions do not have to give you any guidance at all, that it is up to you to get the guidance from not the financial institution. So the loan application is fairly simple. It's a 2-page application, and you need to provide basic identifying information, such as your organization name, the tax identification number, if it exists, your average monthly payroll, the number of jobs supported by your company, and what specifically you want to use the loan money for. Additionally, you need to include a list of any owners or interest of at least 20% in the organization, and affirm that nobody on the application is a party to federal crimes. Your lender is also going to ask for documentation to support your employee headcount and payroll costs over time. So we've also been getting questions about what constitutes the headcount. How do you calculate the headcount? And that is going to be, you could probably, as Matt said, get this from your payroll provider, but for every salary that is calculated into your aggregate, that will be your headcount. And that is all I have on PPP. Do you think it would make sense to take some questions? Oh, have we had, sorry. Do you think it would make sense to have questions now or hold them till the end?
If anybody has questions, I think maybe the best way to do it for the breakout session is put them in each subtopic. We'll give a little break. So
okay.
If anybody doesn't have any now, I would say let's continue.
Okay, so now I'm going to talk about the economic injury disaster loans. Yes, so these are loans that assist in rebuilding after the disaster, in this case, COVID. These provide up to $2 million of financial assistance. The actual loans are based on the amount of your economic injury. So these will help you meet your necessary financial obligations that your organization could have met. Sorry. These will help you meet the financial obligations that your organization could have met had the disaster not occurred. So the qualifications for this are to be small business or private nonprofit organization located in a clear disaster area. The entire country and all of our territories are now declared disaster areas. So the application for this is on SBA's disaster loan website. These loans are handed out through the SBA. When you apply for these, there is a $10,000 grant that you will receive within 3 days. As soon as you apply, you're automatically going to get this grant. So that is a benefit to applying for this. So the non-appealing part of this loan is that there is no forgivable aspect to this loan, but we are recommending that everybody apply for both loans. It is possible to get approved for both loans and take out both loans. You cannot double dip. So if you decide to use the PPP money for payroll, you cannot use your EIDL money for payroll. So since the PPP, you have your 8 weeks of payroll there, it would make sense, since it is forgivable, to use that for payroll first. And then if you needed money for payroll after the 8 weeks, to go to your EIDL money, and kind of stack it in that way. So the EIDL is a fairly easy program, since there's no extra benefit of forgiveness or anything like that. It's a 2.75 interest rate. You can pay it back over 30 years. It's a 1-year deferred deferred payment plan. It's fairly straightforward on that one. And that is all I have on that loan program. If there are any questions on that one. And then the next loan through the CARES Act is the Exchange Stabilization Fund, which is another program that Treasury is going to run. Treasury has not exactly been involved in the grants and loan game, specifically in the disaster space. So this is going to be interesting to see them get out these rules and regulations and build these frameworks. So, so this stabilization fund is going to provide loans and loan guarantees and investments to all nonprofit organizations. So the other two loans were limited to just 501c3s. So this one is going to be for everybody. So we expect these loans to be highly competitive. So if you're interested in going for one of these loans, there is no employee size gap on this size requirement on this one. The other two loans, remember, are capped at 500 unless your organization meets those other SBA size requirements. This one, there are no size requirements on it at all. So these are going to be highly competitive. So if you want to take advantage of this one, we encourage you to get involved quickly. Start collecting all of your necessary documentation now. With this loan, Treasury has until the end of this month to develop the framework for it. They have not done this yet. I am hearing rumblings that it'll be at the beginning of next week, early next week, at the 18th at the latest. And so we don't have much information related to this program. And if I have learned anything from the rollout of CARES and the rollout of Paycheck Protection Act, I am not going to speculate on anything at all, because everything will change by tomorrow afternoon. So however, according to the Act, for this fund, the eligibility requirements are you do need to certify that your organization has economic uncertainty, and funds that are received will be used to retain 90% of your workforce at full compensation and benefit levels before September 30th of 2020, that you have, or you have an intent to restore 90% of your workforce prior to February 1st, while restoring all compensation and benefit levels to workers no later than 4 months after the termination date. You certify that your organization will not outsource or offshore jobs, and that you will not abrogate collective bargaining rights during this time, and you will remain neutral in a union organizing effort for the term of the loan. So we will keep everybody posted as soon as we learn more information about this program, but right now there's not much to say until we learn more. There's a couple little things related to CARES Act tax provisions that will be applicable to nonprofits and your donors. So there's above the line deductions. And so under the CARES Act, an eligible individual may take a qualified charitable contribution deduction of up to $300 against their adjusted gross income in 2020. So an eligible individual is any individual taxpayer who does not elect to itemize his or her deductions. So these charitable contributions can be made in cash, for any charitable contribution deduction is otherwise allowed that is made to certain publicly supported charities. So this is good news that this under what they're calling the Trump tax package, this was removed. So now donors can start giving the above the line deductions up to $300 now. And then there was a modification of limitations on cash contributions. So currently, individuals who make cash contributions to publicly supported charities are permitted a charitable contribution deduction of up to 60% of their adjusted gross income. And any such contributions in excess of this may be carried forward as a charitable contribution in each of the 5 succeeding years. So the CARES Act temporarily suspended this limitation for qualifying cash contributions. Instead, permitting individual taxpayers to take a charitable contribution deduction for qualifying cash contributions made in 2020 to the extent that such contributions do not exceed the excess of the individual's contribution base over the amount of all the charitable contributions allowed as a deduction for the contribution year. So, and then any excess is carried forward as a charitable contribution in each of the succeeding 5 years, so that taxpayers wishing to take advantage of this provision they must make an affirmative election on their 2020 income tax. So these tax provisions can benefit charitable organizations. So Matt, that is all I have.
Great. Before we move along, did anybody have any questions for this piece of the presentation? Well,
Yeah, I had one. I'm sorry to bother you. So, Natalie, you shared with me that again, they're updating because these are very fluid, the regulations, that last night, because I interpreted this about 24 hours ago that, the alternative size of an organization. So on the small, I know they're coming out with a new funding for Main Street that's going to be up to $2.5 billion in revenue and 10,000 employees. But under the current P3 program, they talked about alternative sizes, and I think they clarified it last night, where if you had, and it makes sense because these are the human service organizations that need it the most. If you have net assets of $15 million or less, or your combined surplus in the last 2 years did not exceed $5 million, it didn't matter the size of your revenue under the NAICS code or the employee size. Can you just speak to that? Because a lot of our clients might do $100 million or $120 million in revenue and have 1,500 to 2,000 employees, but they're not generating that kind of surplus, and they don't have that type of, they don't have a high amount of net assets. They're the ones that need the money. So if you could just talk to that.
I need to look at it a little more and think about it a little more. So.
Okay, because it's what it looks. I know.
Yeah.
I know they came up with a solution to that with what Treasury Secretary announced this morning, which I think we're waiting on the actual regulations on that. But it was announced this morning that they came up with another 2.3 trillion of debt funding, where they're going to have banks lend out this money to companies up to $2.5 billion and 10,000 employees, and then the government is going to buy that debt. So that's an alternative to this on the size. But I think based on the way that you read it, some of it's kind of vague. That if you're $150 million place now on the first tranche of P3, that you might qualify if you haven't made more than 5 million combined the last 2 years, or have that in the net assets. But we shall see.
Right. Yeah, I'm still looking at everything that came out last night and trying to wrap my head around all of that.
Excellent.
And I'm trying to figure out how to send a link. Is there?
You could probably send it in the chat.
Yeah, that's what I'm trying to do. Okay. Kind of repelled technology.
So we wanted to just kind of spend the next part of this breakout session, while some of the guidance that's been enacted might be limited to certain organizations, but we wanted to spend this time to go over some strategies that might be not as limited and pertain to all organizations. So at BDO, we believe it's important to balance your nonprofit heart with a business mindset. And we think that while your mission is the driving force of your organization's work, we want to help you focus on that business mindset. In a lot of the conversations we've been having with our clients and seeing it firsthand, what's happening with most organizations isn't necessarily an issue of a decline in revenue. Revenues, for the most part, have been quite steady. But what is happening is a short-term spike in costs, and this is related to the pandemic, whether as a result of overtime costs and payroll costs, organizations that might need additional equipment and PPE and additional cleaning and maintenance expenses related to your programs. And I think it's interesting to note, while some of these costs might be recoverable in the future via some of the mechanisms in place by the CARES Act or even by FEMA, what is clear is that organizations need to start managing these short-term costs now. And one of the most things that's important right now, it's critical to safeguard finances, and a key element of that is maintaining adequate liquidity. And I think Jackie talked a lot about this and stole some of my thunder about talking about strategies related to future cash flows. But we've always been harping on this and encouraging clients to managing future cash flows. But like Jackie said, this needs to be done on a daily basis for as long as you can reasonably estimate and really help with short-term funding and cost containment. We want to talk about some short-term strategies in addition to some long-term strategies that you can employ at your nonprofit. And when we talk about liquidity, I think we're talking about both inflows of cash and revenue, and then the flip side, which is containing costs. And when we think about some of these strategies, the first that came to mind is engaging your donors. I think oftentimes you have a lot of repeat donors. You have individuals who have planned out their giving and contributions for the year. So not only engaging them now to see if they're willing to make that contribution at this point in time versus later in the year or closer to year end. I think we're also seeing, whether it was a gala, maybe it was a golf outing, or any other fundraising event, you can see if they'd be willing to make that contribution surrounding that event now to help with some short-term cash flow. I think it's still uncertain and things remain unclear whether you can reschedule an event or a fundraising event in the near future. So I think it's important to reach out in that regard related to some short-term contributions or funding now. I know some of our clients are starting to do that, even if you're not necessarily relying on the same donors. I think one of the things that's also happening is Giving Tuesday is launching Giving Tuesday Now, which has always been a global day of giving. They want to do one, and I think it's on May 5th, to respond to the pandemic. And what I would recommend is to start having your fundraising teams develop a campaign around this, to help provide some of that critical funding. And in speaking of if it was a gala or some other type of future event that may not have been canceled, you may want to just get an understanding in terms of the insurance you have at your disposal to see perhaps there's some recovery that you might be entitled to if you look toward rescheduling that event or even having to cancel it. And I think along those lines, it's important in some of these contracts that you have to understand the force majeure clauses. Hope I'm saying that right. I think it's a French word, but it's a provision in your contracts that essentially relieves parties from performing obligations when things arise beyond your control. And I think, the current pandemic with COVID-19 would fall under that. So I'd advise you to familiarize yourself with some of these major contract clauses, including that. And this will help your organization make informed decisions about, maybe you do pull the trigger now and cancel some type of gala or an event, and it might relieve you of any potential cancellation fees or any other damages. The other areas of focus for short-term strategy is whether you own or lease your properties. Speak to both landlords and also the banks about potential forbearance on payments are due. we're finding that, even on the personal side and on the commercial side, this is a short-term remedy. Even though the interest doesn't go away, you may get a little instant relief on some payments that are due. We're also seeing some flexibility if you have any outstanding bond debt. The bondholders and some of the obligors there are willing to waive the principal for 90 days. So situations like this and solutions like that might really be able to free up cash flow for the next 3 months, even though you might just be kicking the can down the road. I think, you need a cohesive short-term strategy as well as a long-term strategy to kind of combine the immediate need for the uncertainty, and then we could weather the storm for the long term. Another area where we're looking to short-term strategy is on the insurance side of things. I think in speaking with some organizations and providers who are self-insured, we're seeing some premium deferral for 90 days on the health insurance, as well as the property and casualty side of things as well. This is something that might really be a valuable type of deferral, depending on how you're insured or what your insurance contracts look like. One thing that we are noting is that a lot of organizations, if you operated residential facilities, or if you operated programs where we're in New York City or some of the other areas that have been affected, I think we're seeing an increase in some of the cases, and the healthcare costs are going to go up as a result of that. So I think those are some of the conversations that need to be having if you're not doing so already. One of the things that we've always looked at as part of our audits is looking at vendor listings, and I think now more than ever, if you take a look at your vendor lists, see what leverage you may have to look toward reaching out to your vendors regarding some type of payment plan. Maybe you can implement a payment plan going forward, or even look to consider asking for some type of loyalty discount. I think you're seeing a lot of flexibility from companies. I think a lot of us probably have vendors that we worked with for a very long time. So have those conversations. I think the real attitude is to not leave any stone unturned. Look at the vendor listings and see where you can maybe free up some immediate cash, or even discounted cash. I think another area of focus that we've been looking at is in regards to if you have a line of credit, and if you have some availability on the line, consider drawing down to have some cash on hand. Not only are interest rates low, it's optimal to borrow in that capacity. With some of the continued uncertainty, I don't think we're going to know necessarily how the banks will continue to react, in a month from now, 60 days from now. So, as Jackie noted, when things were harkening back to the 2008 recession, it may be an interesting strategy to kind of just sit on the cash while you can by implementing some of the draws on your lines of credit. Another pertinent point of information is if you have any agreements where you have financial covenants, perhaps it's a debt service coverage ratio type of liquidity ratios, I'd familiarize yourself with some of the covenants that are in your agreements. Oftentimes, the covenants do allow for an exclusion, extraordinary item. So if you're experiencing non-routine costs as a result of the COVID-19 pandemic, that might be an item that you could necessarily exclude from your covenant calculation. So I think it's probably a good idea to start to talk to whether it's the bank or whoever the covenant is with, to maybe see if some of these increases in costs as a result would fall into a category where you can exclude those amounts from your covenants. I don't think we want to be in a position, in a few months where the covenants failed and then your debt gets called. I think if you're having these conversations now and ironing out the definitions with the banks, everybody's aware of what the situation is. Secondly, I think, as we're seeing, one of the biggest balance sheet type items that's being affected is your investments. And I think the advice we're providing is to actively manage your investments if you're lucky enough to have them and you have an investment committee, or whoever is the steward of your investment portfolio, this has to be actively managed on, almost a daily basis to respond to everything that's happening. If we know a lot of our clients have been involved in some investments that are valued at net asset value, or some of the harder to value investments, maybe 6 months ago or a year ago, the past few years, it's been prudent to have it in there. So it's really important to not only evaluate your current portfolio, but understanding what effect the investments have now going forward. I think one other strategy where we're talking to our clients about is don't be afraid to be a little aggressive on following up on your accounts receivable. It's critical that we understand that those don't age past certain points. And, I think everybody, even though we're in this together, just giving out a friendly reminder and then having your team follow up on receivables to convert those into cash is prudent. From a governance standpoint, I think it's important that organizations not only take some time, if you can, to revisit your bylaws and then other governing documents. I think it's probably a good time to see where some old bylaws that might have been in place, you don't want to be hindered by them. So obviously it's important to actively manage and interact with your board at this crucial time. So revisiting the bylaws, you don't want to find that you have language in there that you would prohibit you from doing something or miss out on any type of opportunity.
Can I just add something to that? A good example of that would be if you qualified for the payroll tax credit. And again, there's a calculation on how that's there's an exclusion up to a certain amount per person, but that's paying the 6.5% FICA, the employer contribution. So you may have something, and because I remember this from the early days going to client board meetings, the first thing clients would ask was, did they pay their payroll tax? And, when everybody moved to electronic payrolls and payroll providers like ADP, that was never an issue, especially with direct deposit and everything like that. So you might want to make sure that you're allowed to do that. And I would also suggest, if you're allowed to do that and it's for a period of time, getting a board resolution. So everybody can remember why you did it, so you can track it, and your auditors are made aware of it. And, you're going to have up until December 31st, 2021 to pay the amount back fully. So you just want to make sure. But like Matt says, that could be an example where you're not allowed to avoid paying payroll taxes, even if in this case you're given that credit. Sorry.
No, thank you. And I was going to say another example in a situation like this, if your organization perhaps has an endowment, you may want to have the board look at, of course, the MIFA and the state rules, but perhaps the board would resolve to look at some type of interfund loan from your endowment so that you could meet operating needs. That's something that might be a helpful mechanism as well. And, I think from a governance standpoint, and Jackie mentioned how critical communication is too, over communication right now is really important throughout all levels between management, the boards. Everybody needs to be in lockstep. I think this is why boards have always had committees to handle certain things, and you really want to lean on those charged with governance and the boards during this point in time. One other thought is regarding internal controls. Clearly, when a lot of organizations are working in a remote type of environment, it's time to revisit old existing structures. You may have to redesign new internal controls and protocols for remote operations. And speaking with a lot of organizations, I know people are taking turns to go into offices, but you may even be in a situation where in certain parts of New York City, buildings are locked down and they can't even get in to see if donors have sent in checks, and they may just be sitting there. So it's important to note that, revisit internal controls, look to see, what you can employ, what new areas of technology might be helpful to the organization as well. When we look out toward longer term strategies, if your organization's net asset composition happens to have a lot of net assets with donor restrictions, if it's possible, you may even want to consider reaching out to your donors to see if they would consider removing any restrictions there. That might be a relief for organizations in terms of unrestricting funding. And with that said, I think we've always kind of realized that you need to innovate on your revenue streams, not only in the look to new funding, but I think it's important that organizations know and are become aware of what, foundations might even be awarding some type of rapid grants, specifically for nonprofits as a result of COVID-19. I think there's been some good articles in the Chronicle of Philanthropy or philanthropy.com. And oftentimes your local governments are the ones that are involved in setting up these rapid response and impact funds that are available to nonprofits, in addition to some of the resources that are available at the federal level that Natalie had previously outlined. So a couple of other areas that I just wanted to quickly touch upon. I think unfortunately in some of the wake of COVID-19, you're seeing a lot of cyber threat. And, now that more of us are using some of the remote technology, some of the cyber actors are trying to take advantage of the disruption. So, I think it's critical that you're aware of, some of these phishing schemes that continue to, look for unauthorized access to systems and data, and just continually be mindful of that, as you kind of maintain your daily routines. So I wanted to share a couple other things with everybody. As the auditors in the room, we wanted to kind of think about the financial statement impact that, COVID-19 brought to the forefront. And, I think most people on the call may be familiar with last year or the year before the adoption of Accounting Standards Update 2016-14, which implemented a new footnote in regards to liquidity and availability of resources. And while it may not have seemed prescient as much at the time, in the environment we find ourselves in now, it's pretty interesting where, the liquidity is just laid out for you in front of that page. So, that's something that you should probably continually manage, be aware of the liquidity and resources, and see if you can quantify, what impact do you think that the pandemic has had on your organization. I think you're looking at some additional disclosures as far as financial statements are concerned, whether it's a subsequent event or it's a potential risks and uncertainties note. And, if investments have been impaired, if, other negative events have happened to the organization, you may need to understand now, sooner than later, if an emphasis of a matter or paragraph is required in your audit opinion. And just wanted to quickly highlight some of the important financial statement areas and thoughts and considerations we've been giving to, what this looks like on a financial statement. If your organization has inventory, start to maybe make plans to figure out a way that inventory counts can happen in a manner that was previously planned, or if not, what type of resources you have at your disposal to count inventory. And then, think about, what potential impairments might be in place as it relates to some of the impacts on global and local supply chains as well. Another area that we're thinking about is, any impact on loans and accounts receivable, and the risk of non-performance. If anybody's, customers and borrowers that you might be dealing with might be experiencing financial difficulties. So, continually focus on receivables to help mitigate any unexpected losses and make sure that you're properly measured for collectability. So another area talked about investments with the recent market volatility, evaluating the impact of if you experience any severe market disruptions on the fair value of your investments, considering if they're impaired or temporarily impaired. I think it's important to, if you're a December year end, looking at the impact that it's had subsequent to year end, and then, kind of assessing the impact during the year. If you're a June year end organization, thinking about what the effect is now and what that means for your financial statements for year end June 30, 2020 in regards to impairment and what testing has been happening. So gathering some of these factors, will help, with your board decisions and then various other matters. One other area is in regards to going concern. I think the new standard a couple of years back required management to evaluate an entity's ability to continue as a going concern, in addition to some of the auditor concessions and documentation that's been done. So, I think continually update that and think about what the potential risk factors are there and things like that. So, it's really a holistic approach when you look at, short-term strategy, long-term strategy, and what the impact might be on your financial statements as well. So with that said, I think we had some questions. I wanted to leave a little extra time to go through them. And just wanted to say, hope everybody has enough toilet paper. But we did get one question in the chat if anybody was expecting to get money from their general insurance company for business interruption. I'll let some of the other nonprofits on the call speak to that, but I think that's why it's important you understand some of the clauses for insurance in your contracts. I would think if you have business interruption insurance, if you have some of these various insurance policies, that you should be expecting to get some of the money. I think, the interesting tidbit that I had seen with related to insurance recovery lately is that Wimbledon, the tennis tournament, since 2000 had taken out a $2 million policy every year on pandemic insurance, which since 2000 an outlay of about $2 million a year, an outlay of $40 million is netting them an additional $100 million back. So, I'm not saying you should have had that, but, I just thought that was pretty interesting, making sure that you understand what's in those insurance contracts and policies.
Hi, I was actually the one who raised that question about insurance. This is Ghassan.
Hey, Ghassan.
Hi, I was wondering, if other folks on the, on the Zoom screen here are actually, going to request from the reinsurance. First of all, if they have that insurance, business interruption services, and second of all, if it didn't exclude a pandemic, because what I've discovered recently is that while we had the business interruption insurance, there was an exclusion clause of a pandemic. So unfortunately, we're not covered. We can't, there's nothing we can get, even though we had the business interruption services due to the clause. So I was wondering if folks had encountered the same scenario or not. So that's why I just wanted to throw the question out to the group.
It's interesting, Ghassan. I'm curious, if anybody else had that or if has explored that option. All right. Did anybody else have any questions? Natalie, did you have any closing thoughts with
Yeah.
5 minutes left that you wanted to share?
I just had one thing that I can't believe I completely missed, I guess because it wasn't in the CARES Act. If you're a nonprofit that is involved in any of the medical response or anything like that, I am going to drop a link over in the chat, but you are eligible to get reimbursed through FEMA grants, helping with finding medical equipment or your sheltering, stuff like that. So anything in the link that I just put in the chat. If you're providing any of that to anybody in the state, your services are reimbursable from FEMA through a FEMA grant. And it's a process. So get off if you have any questions, and I would be happy to walk you guys through it.
And then Natalie, it seems a lot of the CARES Act provisions, whether it's the PPP, are kind of available now. What's the timeline look like on some of the resources that FEMA is providing?
So, the FEMA grants, it's a reimbursable program, so you have to have spent the money. So usually it's fairly quickly. It's within the week they reimburse the first invoice, and then you just keep submitting them as they come.
So you do that on a month basis or weekly?
You could do it on a weekly or however you want.
And to segregate the costs.
And Says the auditors on the line.
No double dipping.
No double dipping. Definitely no duplication of benefits.
I mean, in a COVID environment, you can't double dip at a party either.
Socially distance your money.
I don't think that was allowed before then either.
Only for George Costanza.
Yes.
Well, we have 1 minute before the breakout session ends. Anybody else have any last questions? Certainly, I'm sure Natalie would say the same. Please reach out to us, even if there's something that you can, a question that pops up after the fact. We're really looking to help everybody make sure that not only we understand this properly, but get organizations that the resources they need and deserve. The important work you do, and we don't charge type of things, but we just want to make sure that you have the resources at your disposal to be in a position to successfully carry out your mission.
And reach out to your payroll provider, because they can help with a lot of this payroll related stuff. They have the information.
So great. I think we can then go back to the regularly scheduled program.
Thanks, everybody.
Thank you, everyone.